Are zero DTE options the best options to use on all trades these days? It's a question that I get quite a bit because the zero DTE options or the 0 days to expiration options have really changed how markets trade. The volume on these products are massive. And to take it a step further, because they are such short-term options and they have great leverage, they're really causing a shift in how the overall market trades from day to day. What I'm going to walk you through are some metrics that I use personally to help structure my trades in a way that I'm taking what the market's giving us versus just taking trades that I hope are going to be the best, right? Zero DTE options, you can't ignore them. Do you need to trade them on every position that you take? No, there's a time and a place for them, and here's what I typically look for. When you talk about an option that expires end of the day, the gamma and the theta are extreme. The gamma tells you how quickly those options are going to react to changes in stock price. The theta is the time decay. It tells you how much premium is being pulled out of those options as you get closer to expiration. With options expiring at the end of the day, those options are going to be very sensitive to anything the stock price does. As a result, you want to make sure when you put a trade on, you've got a high level of confidence that a directional move is coming very, very quickly. The time decay also puts the pressure on the timing of that trade because those options are losing value very quickly. That puts the pressure on a long option. So why not just sell a spread? Try to sell an option, put that time decay in your favor. The problem there is even though the time decay is elevated, if the stock does make a big directional move and you're on the wrong side of that move, the credit spreads can struggle as well. So again, when you're using the zero DTE options, you want to have a very strong opinion of which way the market's going to go, or at the very least, that the market is going to make a directional move. If it does, you're going to be rewarded for it. Now, here's how I look at markets, and here's how I decide which options are best for my given outlook. It's not just what I'm hearing on financial media. I look at some metrics that help stack the deck in my favor. I like to start out with a daily chart of SPY. This is the S&P 500 ETF. I've got a range of different moving averages there, pretty common moving averages, nothing overly complex. Down at the bottom, I'm looking at the daily volume, and I'm also looking at the ATR, or the average true range. Couple things I like to see. Number one, on the ATR, I like to see an ATR between 6 and 8 ideally. If I have an ATR in that range, it typically means we've got decent back and forth movement throughout the day. What I don't want to do is trade a zero DTE option when the ATR is dropping rapidly, and let's just say it gets down below 6. That's very typical of a slower moving market, a market that's more conducive to a monthly option or an option that has, between 20 and 40 days left to expiration. Where in a slow market, that extra time can be very beneficial. Gives you more time for the directional move to play out. It also takes the pressure off of that time decay, sucking premium out of your long options. So between 6 and 8 is ideally what I'd like to see. And also, I like to see the ATR expanding. If I'm looking to buy a very short-term option, I want to see that ATR between 6 and 8. Ideally, I'd like to see it pushing higher, indicating that range is expanding, there's more conviction coming into the market, and that typically leads to more follow-through, which is much needed when buying those short duration options. If I take a look at the volume, ideally I like to see volume between 70 and 100 million shares. Why am I talking about volume on SPY when I'm looking to trade options on some of the individual stocks? I find that the volume on SPY is a pretty good indicator of how active the overall market is. If I have good volume on SPY, I typically have good volume in many of the key areas that I trade. I like to see that daily volume between 70 and 100 million shares. If I see it in that range, it typically means there's more conviction behind the movement that can typically lead to more follow-through, which is necessary for us to utilize those short-term options. And it also makes it easier for us to get good fill prices quicker. There's good activity. When you start to see volume like we've seen here recently, that volume is below 50 million shares. We've had a number of sessions over the past few weeks. It's like watching paint dry. Outside of some quick reaction to headlines, outside of the news, we've had very slow conditions. That makes it more difficult to get the follow-through, makes it more difficult to get good fill prices. That's why for me, here lately, I've been trading more of those 20 to 40-day options. Knowing that markets are slower, knowing that we're not getting that range backed by good volume, I want to have more time on my side. Again, I'm looking to take what the market's giving us versus just forcing the market to do something it doesn't want to do. There's a time and a place for those 0 DTE options. Let's just say hypothetically over the next few weeks, we come in and we see that ATR pushing back higher and all of a sudden it's above 8. And we see that volume between 70 and 100 million shares. That typically means we're seeing markets expand, we're seeing more participation come in the markets, and that'll oftentimes lead to more follow-through. Moves that are going to be more conducive to those short-term holds, right? We all want to swing for the fences. We all love how aggressive we can be with those very short-term options. But that does not mean you should trade them exclusively. Take advantage of everything that the options can do for you. Don't back yourself into a corner and force one strategy with one type of option to work all the time. Markets are constantly changing. If you can have some key metrics that you're looking for, that can help stack the deck in your favor. Now, if I look at volume and ATR, does that guarantee I'm going to win on every trade? Absolutely not. All I'm looking for is metrics that I can use that I know will start to stack the numbers in my favor and give me higher probabilities of success on the trades that I take. And I know throughout the year, you're going to see market cycle. There's going to be stretches where you might have a couple months where the short-term options do phenomenal. And you're going to see other stretches like we're in now if markets are slower. We have markets stretched in one direction here. It's been a very slow stretch over the past few weeks. This is where, hey, let's get more conservative. Let's still take trades. Let's still be active, but let's take trades that match up with the current conditions, knowing that as soon as we start to see things open up a little bit, that's when we start to get more aggressive. All right, if I take a look up at the top, look at price action up at the top. What I'm also looking for, some things out of the construction of the candles. Now, I'm not looking for specific candlestick patterns. I'm just looking at how these candles are structured. At the time of this video, you can see that we're in a very strong uptrend. What I'm looking for is on the upside, I want to see a series of daily candles where we closes up near the highs of the session. That's indicative of a market that's very strong with traders that are willing to hold positions overnight. If you start to see that, which you can see on this move to the upside, look how many closes we had near the highs of the day. That's very typical of a strong trending market on the upside. People are willing to put capital to work and hold overnight. That's going to oftentimes lead to those moves that last for a number of weeks at a time. If I start to see the sizes of the candles shrink down, right? If I start to see a stretch like this right here, look at how the sizes of these candles, look at the bodies of these candles. They're much smaller than what we saw on the initial wave to the upside, right? There's not as much conviction here. If I start to see more wicks, if I start to see more wicks above and below the bodies of the candle, that also indicates more indecision. If I start to see on the upside, the highs made early in the session, and then we start to sell off and close near the lows of the session, that's typical of a market that's showing signs of getting tired. You're running out of buyers on the upside willing to hold overnight, and that's typical of a tired market. It's a warning sign that you could potentially be close to that pullback. So if I take a look right here, we're starting to see a little bit more wickiness pop up. You're starting to see more wicks on the upside. Not as much conviction here to hold overnight. People know markets are tired. They're looking for reasons to potentially get more cautious here. Again, doesn't mean a reversal is imminent, but when you start to take a look at these metrics, you start to take a look at volume, ATR, how the candles are constructed, now you start to get a better pulse of the market. We're not turning on CNBC, Fox Business. We're not looking at the news. I'm looking strictly at price and the technicals, and it can give me way more insight into how aggressive or conservative I want to be. On the downside here, if I start to see price action roll over and I start to see some of those candles, you start to see price action sell off into the afternoon. You see some large bodied candles on the downside. That's typically going to come with volume, closer to that 70 to 100 million share range that we like to see. And it's also typically going to come with ATR expanding down at the bottom. And if I start to see that over the next couple weeks, that's my sign, hey, now it's time to look at some of those shorter duration options, potentially a weekly option, potentially some 0 DTE options, because now I've got the conditions that are going to back that decision up and that are going to make it easier for those trades to succeed for me. It's going to give me better odds of success. I'm very much a believer that on the option side, you want to have a mix of strategies, daily, weekly, monthly options, some individual long calls, long puts, some vertical spreads. The more diversification you can add, the better your consistency will be long-term across many types of market conditions. That way you're not focused on one type of market with one strategy. It might work really well for a stretch, but then as soon as market conditions change, everything breaks down. You want to make sure you have things in place that set you up for long-term success. So those are some key metrics that I look for. If you have any questions at all, feel free to leave a comment here on the video, or you can send us an email to info@netpicks.com. We also have a link in the description of the video. You can go ahead and download a free ebook that we have that will walk you through some of these metrics and how we trade options in more detail. All right. So appreciate your time here today. I'll be back with you guys over the next few days with our next video.